So now we are heading to chapter number 4. Chapter number 4 is about stockholders' equity. So when we look at the balance sheet equation, asset is equal to liabilities plus equity. So we are going to concentrate on this section which we call equity. The important accounts under equity that we're going to talk about, if you want to make a sort of a T account, is common stock, preferred stock, additional paid in capital, retained earnings, and over here is treasury stocks, dividends, and then there are two different kinds of dividend. We're going to talk about cash dividend and we're going to talk about stock dividend. So let's start. So these are our topic is going to be. So first we're going to talk about corporation. As we learned in our journey to study accounting, there are multi kinds of entities, but there are three main entities that we talked about. One was the individual owner or individual ownerships when there is only one owner. The second one is various kinds of partnership and LLC, and the third and the most important is corporations. Even though that the majority of the people do not work in corporation in the United States, and the majority of the business are not corporations. So what we are going to study corporations. So when we are talking about corporations, we are talking about publicly traded company, publicly traded company or public companies. When we use the word traded companies, basically what we mean is the shares of the corporation is buy and sell through a stock market, let's call New York Stock Exchange, on a daily basis. So it's a publicly traded company that we're going to discuss. So what is a corporation? A corporation is a legal entity. What does it mean? A legal entity means it has its name, it has its address, it has its own financial statements, it pay taxes. So just like as an individual, you file tax returns on your income, the corporation also file tax returns, and they call the tax your tax return is called 1040EZ, 1040 or 1040A, and they are called 1120C. That's the IRS form to file a corporation tax return. So the founders of corporation prepare and file the articles of incorporation, which define its structure, purpose, and authorized stock. So what does it mean? If you have a business or you are going to start a business and you want to incorporate that business, incorporate means simply to apply to form a corporation with the Secretary of State in any state. If you are in Texas, you will apply that to the Secretary of State in Austin. And you will tell them, these are my articles of incorporation. This is my structure. A structure simply means the CEO, the CFOs, the shareholders, the board of directors, all those. The purpose, what is the purpose of the business, and how many shares are going to be authorized. We're going to discuss this authorized stock more in detail a little bit later. If approved by the government means the Secretary of State in the Austin approves the application, the founder next elect the board of directors and adopt corporation bylaws. So what does it mean by board of directors and what does it mean by founders? So for example, Jane and Amy found a corporation, and that corporation sells handbags, for example. So they are the founder, they started the business. Now they want to incorporate. So board of directors could be shareholders or could be the people that are hired in the board of director or request, if hired is not a right word, but we will request them to join our board of directors. So board of directors is like a committee of elders. So the board of directors could be shareholders or could be there because of their expertise. Maybe it's expertise in the legal department, in the tax area, in the financial statement area. It may be in the business, marketing, management. You can have anybody as a board of directors, the founders elect or select, but usually the board of directors represents the shareholders. So if the founders have all the shares of the corporation, means controlling or holding the shares of the corporation, then they elect anybody as a board of directors. These board of directors basically hire the CEOs, the CFOs, the COOs, and CIOs for the company. And the C people basically report to the board of directors. The board of directors also have a responsibility to hire an independent outside auditor, and that auditors reports back to the board of director. And the board of director has a subcommittee called audit committee, and that audit committee has 3 to 5 people, and they deal with the auditors, and auditors always report directly to the board of directors. So to obtain funds needed to begin operations, the corporation sells capital stock to the stockholders, owners of the corporation. So for example, if Jane and Amy started the business, suppose their business has a net asset minus liability, the net asset says $100 million. And initially they issue 1 million shares. Those 1 million shares are sold to the people outside the business, and they can sell it for whatever money they want to charge, $10, $20, $25, $100. That's another, there is a way of calculating it, but I don't want to go in that detail here, that how that number is calculated, how much you're going to get. And that once they get the money, those people have the presentation. So one person can at least buy 1 share to be a shareholder, and one person can buy many shares, 100 shares, 1,000 shares, 10,000 shares out of the 1 million shares. So once they have these shares, these people like to elect a board of directors. So maybe there are thousands of shareholders out there. They may elect 10, 15, or 20 people as board of directors. Or the person or the shareholder who has the highest number of shares may want to sit in the board, because of course he owns the part of the company. So shareholder is basically owns the part of the company. All right, here is the corporate stockholders structure. So on the top is the stockholders or shareholders or the owners of the corporation. So these are the people who owns the corporation. They elect a board of directors. So they elect the board of directors. Board of director hires these officers, and these officers run day-to-day operation for the corporation. And these officers hires these employees. So these employees support these officers, and these officers report back to the board of directors. And which officer report is mostly the CEO and the CFO that goes to the meeting with the board of director. Again, what are the advantages? We have discussed these advantages in the past. It's a separate legal entity and it has a limited liability. So what does it mean by a limited liability? For example, suppose I am a shareholder of Walmart, and suppose I own 1,000 shares of Walmart, and you, the listener, go to any Walmart and then you slip and break your bones in the wall, and then you, in return, you sue Walmart for $1 million. And if you are successful, you will receive $1 million from Walmart, the corporation. But I, the shareholder, is not responsible for the accident. And as a shareholder, I am not going to pay you anything. You cannot come after me because I am the shareholder of the Walmart. So the cash or the fine is coming from the corporation. Keep in mind one thing, that if the corporation is paying $1 million in fine, say Walmart, that $1 million could go into my pocket as a dividend. But unfortunately, since you fall and break your bones, Walmart is paying you the fine. and I may lose. So indirectly, I am losing some money, but limited liability simply means you cannot go after the shareholders. In case of injury, you can always go after the corporation. Transfer of ownership. What it means that I can buy and sell shares in Walmart at any given time. Today, I feel like buying shares for Walmart. I can go and buy Walmart shares. Tomorrow, I feel like buying Google shares. I can buy Google share. And 2 months down the road, I want to sell back my Google share or Walmart share. I can sell both or either, whichever. Continuity in existence. Let me give you an example you're familiar with. Ford Motor Company. The Ford Motor Company was founded about 120 years ago. This is maybe the fourth or the fifth generation of the Ford family that are running this business. So you can see the original person who found the company has died long time ago, but the business is still in continuation. But if I find, say, my CPA practice tomorrow and 20 years down the road I die, that company would cease to exist because I'm the only one who was running that company. Okay. Second is capital raising. What is capital? We're talking about dollar. So how easy that it is easy to raise capital. So when we are selling initially the Jane and Amy were selling their shares, 1 million shares in the company, what they are doing, they are raising the capital to expand the business. So the two of the other advantages, as we thought, transferability of ownership and specifically limited liability. So we have a transfer of ownership simply means that Jane and Amy can transfer their share to their family members, for example. What are the disadvantages of having a corporation? Is organized cost. It could be in thousands because you are paying to a lawyer, you are paying to the CPA, you may be paying to the bank in order to prepare all the paperwork. Taxation. Why taxation? As I said earlier, a corporation is a legal entity. If it is a legal entity, they have to pay tax. And what happens, so the revenue minus expense is equal to income. So if the corporation has the income, they have to pay tax. Once they pay the tax, I, the shareholder, receive the dividend. And then as a shareholder, that dividend becomes my income because I have received cash, so I have to pay. So it's called double taxation. So the corporations are famous for double taxation because first, the corporation has to pay the tax on their income, and the shareholders, if they receive the dividend, they will have to pay the tax on their dividend as well. Regulation and supervision. There are so many regulations from SEC, EPA, OSHA. All of those people are watching you. If you make any mistakes, then you will have to pay the fine. So these are important things to keep in mind, but it's still the corporation is considered a best form of doing business. Now we're going to talk about a stockholder's equity. A stockholder's equity, also referred to as shareholder's equity, is the same thing. A stockholder, shareholder, a stock and share are interchangeable. Is the sum of all residual claim against net asset of the firm and is measured as the difference between asset and liability. So earlier I showed you asset is equal to liability plus equity. So asset minus liability is equal to equity. So if you sell all the assets and paid all the liabilities, whatever remaining is your equity. Another good example is if you own a house. Suppose you own a house and you want to sell. You sell a house for $100,000, but unfortunately you still owe $20,000 to the bank. So after paying $20,000 to the bank, you left with $80,000. So that $80,000 was the equity in your home for you. Okay. The next thing is, it's also called net asset or the book value of the firm. Yes. The book value of the firm is different from the market value of the firm. The book value of the firm comes from this. This is the book value of the firm. What is the market value is the firm? Market value of the firm is what the people think. So let me give you an example. Suppose you have a very nice handbag You purchased that handbag 2 years ago for $100. So after 2 years, you may have depreciated. This handbag is now for the book value of that after depreciation is $50. But I believe that your handbag is very classic or very classy, and I am willing to offer you $150 for that same handbag that you purchased for $100, which has a book value of 50 at this very moment, but I'm offering. So your book value of the asset or your handbag is 50, the market value is 150. So market value is the value that the market or the people outside the business is willing to pay for the book assets of the company. Shareholders' equity represent the interest held by the investor. So this is the equity. So in your home, you are the only shareholder. If you are married, then it's going to divide it between you and your wife, for example. So whatever left over is divided between the share. So everything goes to the creditors first, then whatever left is for the shareholders. So everything, whatever left, so 80,000 left is going to divide it between the number of shareholders. Shareholder can assert their claims only after company has satisfied the senior claims of the creditor. So once you paid off the liability, whatever left over would be part of your equity or part of your whatever money you're going to receive. Now we're going to talk about the components. There are a couple of things. Contributed capital includes the amount paid in by common and preferred stockholders, and common shareholders are the residual claimants or individuals, other corporation or institution of the firm who receive dividend distribution after the company has paid all other providers of capital their return of investment. So what does it mean in simple language? A corporation has a contributed capital. A contributed capital is the capital which was provided to you by the shareholder. All right. And are the residual claimants, means shareholders only claims once the creditors has got all their money or you have paid all the liabilities. That's all it is. Preferred shareholders are investors holding shares in the company who have preferential rights over common shares. So there are two kinds of shares basically. One is called common stock, the other called is preferred stock. A preferred stock is basically a hybrid between common stock and a long-term liability like a bond. Why? Because the preferred stockholder, common stockholders have the right to vote. Preferred stock usually do not have the right to vote. However, when it comes to dividend, preferred stockholder receive their dividend first, and if there anything left over then goes to the common stockholder. Hence the word preferred, because they are preferred to receive dividends. Contributed capital includes additional paid-in capital in excess of par or stated value. So for example, the face value, if the face value of common stock is $10, but it's selling for 15. So the difference of $5 is additional paid in capital. So this is the face value, but it's selling or the price is $15. So the stock shareholder who is purchasing, giving you extra $5, that $5, anything beyond the face value of a common stock or a preferred stock would be considered additional paid in capital. Retained earnings we discussed in last time is a cumulative earning or losses that it has not distributed as dividends. Always remember, dividend comes from retained earning. So retained earnings is basically accumulation of the earnings that has not been distributed in the name of cash dividend. Accumulated other comprehensive includes items such as unrealized gains and losses on available for sale investment securities, foreign currency, translation of adjustments, and certain pension. I'm most likely not going to ask you a question about AOCI, but this is, you need to know, unrealized gains means if you have an asset, you're holding a land, for example, and that land you purchased for $1 million, now it's $2 million. but the book value is still saying, so you have a $1 million unrealized gain. The gains are only realized once you sell it. Okay. Again, we're going to talk about authorized shares are the total number of shares that firm can legally issue. So for example, a firm can issue maybe 100,000 shares, a million share, 500,000, depending. Typically, the Attorney General in the state of incorporation approves the authorization based on your paperwork you file. Firm includes the number of authorized shares in the article of incorporation. They have to mention how many authorized shares. Means if they have 100,000 authorized shares, they cannot sell more than 100,000 shares. Issue shares are the number of shares sold or otherwise distributed to stockholders. So authorized shares, the number of shares you are authorized to sell. Issued shares means the shares in the hands of the shareholder. Unissued shares are shares authorized but not issued. Keep that in mind. So you may have 100,000 authorized shares and you issue only, your issue shares are 50,000. So unissued shares are 50,000. All right. Treasury shares are the corporation owned shares repurchased by the corporation and held for some future use. So for example, you purchase back 10,000 shares and you now have 40,000 shares in the hand of the shareholders, but this 10,000 is called treasury shares. You may are keeping in the hands of the corporation because you may want to give to shareholders as a dividend in the future. Outstanding shares are the number of shares still in the hands of the shareholder. So that 40,000 will be considered the outstanding share, computed as issued share less treasury shares. Used for financial statistics such as earnings per share and book value per share, cash dividend payments, and determine those. So these treasury stocks do not receive dividends. Only the outstanding shares in the hands of shareholders receive dividends. And when we calculate the earnings per share, we only use the outstanding shares. Okay. The next thing we're going to talk about is the legal issues and par value and stated value. The concept of par value required to maintain a minimum amount of capital. So for example, if you are selling a share for $10 and you are selling 100,000 shares, so that equals to $1 million. A company needs to keep $1 million at any given point while these shares are in the hands of the shareholders, in case if the shareholders come back and demand their money. So it's important. An original purchaser of the company share could be liable for any amounts contributed below par value in the event of corporate liquidation. So what happened? If your company goes bankrupt, the only money that as a shareholder you're going to lose is your investment. Many states no longer require minimum capital and permit no par stock. No par stock simply means it has a no face value. Whatever is coming in, it's basically additional paid-in capital. Okay. Par values are usually set as an immaterial amount, as mostly 1 cent, for example. A stated value is an amount of legal required specified by the board of directors in the absence of par value. So if there is no par value, they will call it a stated value. It's the same thing. Stated value and par value, no difference. It's just the legal definitions are different. Common stock issued for cash, most likely that the companies in their initial life, they sell their shares for cash so they can expand their business. A stock issue cost, companies typically incur costs related to legal underwriting fees. So for example, Bank of America is your underwriter. You have to pay them a 1% or 0.5% or 1.5% as an underwriting fees because they're going to take care of your IPO or initial public offering. You have to pay attorneys, you have to pay the CPAs, you have to pay the SEC or the state of incorporation, say Austin, some of the fees. The underwriter buys the share from the issuer net of the fee and then sells the shares in the market. Okay, and the firm treat this issue as a reduction of additional paid-in capital in excess of par. Common stock issued for non-cash. A company can issue stocks to get a service from a lawyer. So for example, lawyer fees is $50,000. Hey, I will give you 1,000 shares. I don't have the cash. Or you pay your CPA instead of cash with the stocks. You can purchase buildings, materials, other assets using a stock, and that will be your stocks, but you are not paying any cash for them. Par value is of little significance today. People really don't care. It has some legal implication concerning minimum issue prices. Legal capital, the minimum amount of contribute that must be maintained. So if you are selling a share with a $10 face value, that means you have to maintain for 100,000 shares $1 million. But if you are selling a share with a face value of 1 cent, even if you sell 1 million shares, you have to keep a very little money. So in order to not to hold that large amount of money, people have reduced the stated value or the par value to as little as 1 cent. Again, capital stocks under 3 categories: authorized share, maximum number of shares that may be issued shares sold to stockholders, outstanding share, issued shares that have been issued and remain in the hands of the shareholders. Okay, the next thing we're going to talk about, the common stock. So basically what we are talking about, what kind of power the common stock has. So this is the most basic type of capital stock. Only one type it represents common stock. It is a voting right. So these are the one right. First right is they have a voting right. They vote. Shares in the corporation's net income, they receive dividend. So this is what we are talking about, dividend, right to receive dividend. Has a preemptive right. What is a preemptive right? For example, a company ABC initially issued only say 1,000 shares later, and you purchased 25% of the share. Now so you own 25% of the company. So again, they are issuing another 1,000 shares. So they will ask you first, hey Jim, you own 25% of the company. Do you want to buy or do you want to keep your 25%? If you want to keep your 25%, you have to purchase 250 more shares of the 1,000 new shares that I'm selling. So that's called preemptive right. If you choose not to do it, they can go to somebody else, but give you the first. And you have a residual claim on the assets in the event of equity. So these are the 3 and 4 rights the rights common stockholders have. So I'm going to stop this video right here, and we're going to meet in the next video with the rest of the chapter.